What if I told you that the scariest times in the stock market could actually be your biggest opportunity? I know, it sounds crazy. When the news is screaming about a market crash and everyone is panic selling, the last thing on your mind is buying. But what if that's exactly what the smartest investors do? Today, we're going to talk about something called contrarian investing. It's a strategy for not just surviving a bear market, but actually profiting from it. We'll break down how to spot opportunities when everyone else is running for the hills, what to look for in companies that can weather the storm, and how to build a portfolio that can turn a crisis into a major win for your financial future. This isn't about timing the market perfectly, it's about changing your mindset. So, if you're ready to learn how to turn fear into fortune, stick around. First, let's get on the same page. What exactly is a bear market? Generally, it's defined as a period when major market indexes, like the S&P 500, drop by 20% or more from their recent highs. This is usually accompanied by widespread pessimism and negative investor sentiment. People get scared, they sell their stocks, and that selling pushes prices down even further. It's a cycle of fear. Now, the natural human instinct is to join the crowd. When you see your portfolio value dropping day after day, your gut screams, "Get out now before it goes to zero." But contrarian investors do the opposite. Their philosophy is simple. Be fearful when others are greedy, and be greedy only when others are fearful. This quote, famously attributed to Warren Buffett, is the core of contrarian thinking. They believe that the market often overreacts, pushing prices of great companies far below their actual value. The widespread panic creates a massive sale on the stock market, and if you have cash ready, it's like a Black Friday event for investors. So how do you actually find these golden opportunities during a downturn? It starts with a what. You do want to be scrambling to figure out what to buy when the market is in freefall. The best time to prepare for a bear market is before it even happens. You should have a list of high-quality companies that you'd love to own, but whose stock prices are currently too expensive. What makes a company high? Look for businesses with a strong competitive advantage investors call a moat. This could be a powerful brand, like Apple or Coca-Cola, unique technology, or a dominant market position. These companies are more likely to survive an economic downturn and come out even stronger. Next, you need to dig into their financials. You want companies with a fortress-like balance sheet. That means they have low debt and plenty of cash. A company loaded with debt might not survive a recession when its sales decline. But a company with a lot of cash can not only weather the storm but also acquire weaker competitors at a discount, or invest in research and development to get ahead. Think of it this way. In a storm, you want to be in a sturdy ship, not a leaky raft. So, look at metrics like the D-to-equity ratio and the current ratio. A low debt-to-equity ratio is good, and a current ratio above 1 suggests they have enough short-term assets to cover their short-term liabilities. Don't get bogged down by the jargon. These are just tools to see if a company is financially healthy. Once you have your watch list of strong companies, the game becomes one of patience. During a bear market, you start seeing these amazing businesses go on sale. The key is not to try and catch the absolute bottom. Nobody can do that consistently. Instead, a great strategy is dollar cost averaging. This means you invest a fixed amount of money at regular intervals, say, every month. When the market is down, your fixed amount buys more shares. When it recovers, those extra shares you bought at a discount can supercharge your returns. It takes the emotion out of investing. You're not trying to be a hero and time the market. You're systematically buying into great companies at better and better prices. Let's talk about a real-world example. Think back to the financial crisis of 2008. It was pure chaos. Banks were failing, people were losing their homes, and the stock market was in a nosedive. The sentiment was apocalyptic. But what happened if you'd invested in a solid company like Amazon back then? At its lowest point in late 2008, Amazon stock was trading for a split-adjusted price of around $3 per share. People were worried that consumer spending would evaporate and crush the company. But if you looked at its fundamentals, you'd see a business that was still growing, innovating with things like Amazon Web Services, and building an incredible logistics network. Those who bought during that period of extreme fear and held on saw their investment multiply many times over the next decade. This is the power of contrarian investing. It's about seeing the long-term value when everyone else is focused on the short-term panic. Now, a word of caution. Contrarian investing is not about buying any stock that has gone down. That's a recipe for disaster. There is a difference between a great company that is temporarily on sale and a failing company that is on its way to zero. This is why the initial research is so crucial. You need to distinguish between a falling knife and a genuine bargain. A falling knife is a stock that is dropping for a very good reason, like its business model is broken. It's losing to competitors, or it's buried in scandal. Buying these is like trying to catch a falling knife. You'll get hurt. A true bargain is a solid, profitable company that's been dragged down by the overall market panic, not by its own failures. Always ask yourself, is this company's problem temporary and market-related, or is it a permanent problem with the business itself? Another powerful tool for bear markets is investing in sectors that are traditionally resilient. These are called defensive sectors. Think about it. During a recession, you might put off buying a new car or a luxury watch, but you're still going to buy groceries, toothpaste, and electricity. Companies in sectors like consumer staples, healthcare, and utilities tend to have more stable earnings because their products and services are always in demand. While they might not give you the explosive growth of a tech stock during a bull market, they can provide stability and dividends to your portfolio during a downturn. Adding these to your mix can act as a shock absorber, smoothing out the ride and giving you the psychological strength to stick to your plan. Let's also touch on mindset, because it's arguably the most important part of this strategy. Investing during a crash feels unnatural. Your brain is wired to avoid pain, and seeing red in your portfolio is painful. The media will fuel this fear with sensational headlines. Your friends might be panicking. You need to be able to disconnect from that noise and trust your research. Remind yourself that market crashes are a normal part of the economic cycle. They've always happened, and the market has always recovered, eventually reaching new highs. Your goal isn't to avoid the storm, but to have your ship prepared to sail through it. This means having cash on the sidelines, ready to deploy, and having the conviction to buy when every instinct is telling you to sell. It's a test of discipline more than anything else. So, to recap the strategy. First, prepare in advance. Build a watch list of financially strong companies with durable competitive advantages that you'd love to own at a cheaper price. Second, when the market turns sour and pessimism is everywhere, that's your signal to start paying attention. Don't panic sell. Instead, start buying. Third, use dollar-cost averaging to systematically invest. This removes emotion and helps you buy more shares when prices are low. Fourth, distinguish between a true bargain and a falling knife. Stick to high-quality companies whose problems are temporary, not fundamental. And finally, cultivate the emotional discipline to act against the crowd and trust your long-term plan. Bear markets are tough. There's no doubt about it. They test our patience and our resolve, but they are not the end of the world. For the prepared and disciplined investor, they represent a rare opportunity to build life-changing wealth. By shifting your perspective from fear to opportunity, you can turn a market crash into your single greatest investment advantage. The next time the market starts to tumble, I hope you won't see it as a crisis, but as a chance to buy the future at a discount. Thanks for watching today. I hope this gave you a new perspective on how to approach market downturns. If you found this helpful, be sure to hit that like button and subscribe for more content on smart investing strategies. Let me know in the comments what your go-to strategy is for a bear market. Stay safe and happy investing.